We'll continue our conversation and focus on the MPC decision day. About 2 p.m. today, the MPC, the Monetary Policy Committee, will be announcing its decision on key rates as well as other matters developing with regards to the economy. Speaking to me now is an investment lawyer, Ifemusa Humuavi, who joins us from the United Kingdom. Good morning to you, Ifemusa.
Yes, good morning, Harriet. Thanks for having me.
It's great to have you on the show. We had slight issues getting you on the program yesterday, but hey, here you are. Let's quickly get your thoughts on what you expect from the MPC meeting when it ends, from the Monetary Policy Committee when it ends its meeting at 2 p.m. today.
Yes, thank you very much, Harriet, for that. Actually, before yesterday's meeting, yesterday there was a circular from the Accountant General changing or altering the TSA regime by removing about 13 MDAs and NDAs and parastatals from the TSA regime. Markets have always expected that the MPR will remain at 13%, the CRR will be at 21%, or will come down to 21%. They will retain the liquidity ratio to 30%, and there will be slight retention or adjustment in interbank foreign exchange markets. But with the announcement of yesterday, I think things are beginning to change a bit. I didn't have issues specifically with regards to the adjustments in the interbank foreign exchange. My issue rests with the possible review of the CRR, which I think it might be counterproductive. There are two schools of thought on the question of whether the CRR will guarantee liquidity in the economy or not. The ideological view is that it will automatically lead to liquidity and loans, and in fact, the whole market will be awash with loans or liquidity. But viewing it from the functional school, which I belong to, I think liquidity is a question of environment. Liquidity is like a plant. If you must germinate in a fertile soil for it to be effective. You need a rapprochement between the monetary policy and the fiscal policy in an investment environment to guarantee effective liquidity or lending in the market.
Well, right now we don't have, there's no fiscal authority, there's no economic team, and so basically it seems as if the monetary authority is working as best as it can to ensure that there's improved liquidity in the system. But for how much longer do you think this can continue?
You see, this is the challenge we're having, because from the investment side of things, investors would look at a possible review of the CRR downwards under two conditions, or we'll give it two interpretations. One will go to the very question of the solvency of the banks, some of the banks. Then the second one will go to the question of the policy placidity. Now, I'll take on the first one. On the question of solvency of the banks, investors are beginning to see that as or interpret this to mean that the monetary policy or the monetary committee is giving a stimulus to the bank to finance short-term or operational expenses. Which, of course, shouldn't be the case. It goes to the question of solvency of the banks, because in the light of 10% of deposits being covered by TSA, subject to yesterday's announcement, we do not see any reason why the banks should be complaining about having sufficient funds to finance short-term operating expenses. So on the question of the policy placidity, I think it is not right for us as a government or as an institution to engage in policy that would be dead on arrival. Because the idea of going ahead with a reduction in CRR when the environment is not ready, you have investors are waiting on the sideline. You want to lend at what interest rate? At 13%? Benchmark rates? That is too high. And we're talking about 25, 26%. Within the banks, that is uncompetitive. So I think we need to get ready. We need to start now. The Monetary Policy Committee must engage in a constant rapprochement with the fiscal authorities. The government must set a clear direction for things to move on. And if you're asking me what timeline, I would say now. We need to have a cabinet. While the cabinet is ongoing, while they're moving on with the clearance from National Assembly, we should have an economic blueprint for investors to digest. Now, if you look around the world, we've had countries that have had similar problems. In 94 to 95, Brazil had a problem. Professor Cardoso then, who was the Minister for Finance in Brazil, sat down night and day with the Monetary Committee in 94-95. We had the same problem, the tequila crisis in Mexico in 94-95. We had similar problems in Bulgaria in 96-97. We had similar problems in Russia in 98-2000. If you look around now, given the current position, the way things are, you have countries who depended on commodity when it was good. Countries like Mexico, Brazil, South Africa, Australia, Canada. They are having similar vulnerabilities as we have now. If you go to these countries, you see the fiscal and monetary authorities sitting night and day thinking on how to get out. So what I will ask the government to do, and I want it now, is to set up a committee, get an economic blueprint so that investors can begin to digest. Thirdly, the interest rate must come down. It's uncompetitive. It cannot happen. Fourthly, we must be looking at setting up, investing in infrastructure. When I mean infrastructure, I mean both hard and soft infrastructure. The hard infrastructure being the service sector and the industrial sector. The soft infrastructure should mean a robust investment and robust policy in the area of social welfare. We should be looking at strengthening the pension system. We should be looking at strengthening the educational system. We should be looking at strengthening the health system. Then fourthly, we should start looking at reforming the civil service, or we should not look at reform as a whole. Anti-corruption reform. We should look at labor reform. We should look at reforming.
Ipemosa, let me interrupt you here. You've listed so many things that should happen and must begin to happen now, especially with regards to this rate, that the MPC should be looking at changing or reducing, or as the case may be, reducing the CRR on private sector deposits especially. But what would happen? What do you think will happen if they decide to maintain status quo and not shift either on the monetary policy rate or the CRR or even the liquidity ratio?
Yeah, if nothing happens from the MPC side of things, I won't be surprised. In fact, that's what I expect, because the MPC cannot act when you don't have a fiscal authority, when you don't have an economic blueprint. It's not responsible for the MPC to act, because you'll be acting, in fact, for the last 6-7 months, we've been seeing all sorts of policy flip-flops here and there. So we cannot expect the Monetary Policy Committee to act. We just had a TSA issue. A TSA issue that, just 5 days, 6 days ago, we just had a TSA issue. It was set up to fight corruption. Now we are having certain ministries taken out of the TSA regime. Let's look at what CSA is supposed to do. The CSA is supposed to aggregate public resources into a single pool to help for efficient management and control, to help for effective payment system and reconciliation.
Ipemosa, we'll have this conversation on the TSA on another program. But right now, we're fast spent for time. Thank you so much for joining me on the program and sharing your perspectives with us.
Thank you very much.
And that's it on today's show. Many thanks for spending time with us. I'm Harriet Agbinyi. Have a profitable day.